Hello, everyone. Thank you for joining us today. Today, it's our pleasure to have Professor Yukun Liu from the University of Rochester. So, Dr. Yukun Liu is an assistant professor of finance at the Simon Business School, University of Rochester. His primary research fields are asset pricing, fintech, machine learning, and labor. Prior to joining the University of Rochester, he received his PhD in economics from Yale University and a BA in economics and mathematics from Cornell University. So very impressive CV. And Yukun Liu is one of the first finance scholars that studies blockchain, cryptocurrency, and NFT. And he has published a few papers on top finance journals. So without further ado, let's welcome Professor Yukun Liu to give us this presentation. Thank you.
Yeah, thank you, Chen. Let me share the screen. All right. So if anyone has any questions, just stop me. Yeah. Today I'll talk about the economics of non-fungible tokens. It's a joint work with Nicola Bori and Alei Chivinsky. The goal of this paper is to understand the returns of the overall NFT market. Think about the NFT market. It's quite different from many of our familiar asset classes, even from like cryptocurrencies, because for many of these asset classes like equity, cryptocurrency, commodities, and so on, typically you have a bunch of the same thing that are being traded. You can they're all we call them fungible to each other, right? They're interchangeable from each other. And because of the large amount of things you can trade on, and that provides essentially liquidity, and you can observe prices in relatively high frequencies every time they trade. But for NFT, on the other hand, it's non-fungible. Essentially means that they're not interchangeable. One NFT is designed to be different from the other NFT, and each individual pieces is only traded very infrequently. So what is this like? This is it's more like houses or like physical arts or stamp, those kind of things. Okay? So the way we do this to understand the NFT market is to first construct an NFT index. Okay? And then we're going to study the properties of this index. The primary method we're going to use to study to construct this NFT index is to use the repeat sales regression method, which have been popular in applying to different types of non-fungible assets in general, such as houses, which is the famous Case-Shiller housing index, and other kind of non-fungible assets, like, for example, art or like wine or stamp and so on. I'm going to talk about why we decide to use the repeat sales regression method instead of some other methods which are also being used in this literature. We think it has a particular appeal to this particular asset class, which is the NFT. What we find is that this is to the end of 2021, so it doesn't cover the recent kind of decline in value in almost everything in terms of assets. So bear with me on that. So we find that on average, the returns on the NFT index from 2018 to the end of 2021 is high, about 2.5% average returns, but very high volatilities, 19.2% volatility. That gives you a Sharpe ratio of about 0.939 annualized, which is actually pretty similar to the stock market during the same period of time. In terms of exposures, it does have some exposures to the cryptocurrency markets. However, even if controlling for that exposure, there is still a large kind of idiosyncratic component, if you like, residuals of the NFT aggregate returns. In terms of its exposure to traditional asset markets, there is not too much. And then after documenting some of these basic kind of properties of the NFT aggregate markets, we can look at predictabilities, both in terms of time series and in terms of cross-sectional. In terms of time series, essentially that's asking what are the kind of characteristics of the NFT market that can potentially kind of forecast future NFT performances. You find that two things are important: volatility, valuation ratio, and many of the other candidates are actually not going to be important in terms of time series predictability. In terms of cross-sectional, essentially this is asking for the same period accounting for the aggregate time trends in the NFT market. For the individual NFTs, which one tends to have higher, what kind of characteristics would give you a higher average returns, and what kind of characteristics would give you lower average returns. We find two effects over there. The first one is this size effect, which is very much similar to the size effects we document in other asset classes. Essentially, the larger NFTs here is defined by the NFTs there with higher prices. They tend to have lower average returns going forward. And then there's also the reversal effect. We actually don't find any momentum effect. We think the reason for that is because momentum effect, typically you observe that in short to medium horizons, reversal effect you observe in longer horizons. And because of the trading frequencies for these NFTs, typically on average, we find it's about 30 weeks. At this horizon, you don't see any momentum effect anymore. So let's look at the data and methodology we use. In terms of the data, we use the major exchanges from 5 major exchanges in general: CryptoKitties, Gods Unchained, Decentraland, OpenSea, and Atomic. What we do is we use these, we get all the transaction data from these 5 exchanges, which includes information on each transaction time of that transaction, the prices being transferred, what kind of denominator, like is it in Ethereum, Ethereum, Mana, USD, whatever. And also, actually, we also have the buyer-seller informations and like the characteristics of the collections and so on. What we're going to do is we're going to aggregate the sales into weekly. So essentially, if some of the NFTs they got sold very fast, for example, in each sale in a week, it could be a particular NFT being sold like twice. Then we're going to take the average of the sale prices as this week's kind of price for this particular NFT. Of course, we also do it in the daily level, which will give you similar results but higher frequency. We only focus on the ones traded on Ethereum, Ethereum, Mana, and USD. I see a question. So if you have a question, just ask out loud. Sometimes I don't see the kind of chat, but so it'll be easier. So the question is, did we consider other NFT marketplaces as super rare, nifty rareables, etc.? We did try to do that, but unfortunately, they don't provide any kind of way to download their data. These are the ones that allow us to download the data. Okay, so that's how we determine the exchanges. But they do include the most important ones, right? Like OpenSea, Atomic. There, like OpenSea is by far the largest in terms of dollar volume. Atomic has a lot of sales over there. Yeah, we do want to get the other ones, but they don't provide like an API to do that. Okay. Any other questions? Okay, very good. So let me continue on this one. The way we're going to do this exercise. Oh, there's another question. Oh, a variable has an API. Oh, okay, that's useful information. I should check that. Okay, thank you. Oh, actually, maybe it's a new thing because before I actually looked into that and I didn't find it. But that's good news for sure. So the way we're going to construct this index is to use this repeat sales regression method. So let me introduce the method to you if you're not familiar with that, and then we're going to talk about like why we use this method. So think about this method as essentially breaking the return of a single NFT's repeat sale, meaning that it's being sold twice, right? Because it's sold twice, you can calculate the return for that sale into two components. One is a component that's the aggregates, and one is a component that is idiosyncratic. So for example, NFT I is being sold twice. The first time is sold in time t, the second time is sold in time t prime. T prime is later than t. Then the PIT prime over PIT, that's just going to be the gross return of this particular NFT repeat sales. By the assumption, there are two components. One is the component that is the aggregate component. The markets of the NFT in general went up or come down. So this is the B part. So it doesn't have any I to it. That market index at time t is BT, and time t prime is BT prime. With multiplied by the idiosyncratic part that is specific to NFTI, which is the UITT prime part. If we make this assumption, which is the repeat sale regression assumption, you can take the log of everything, which will give you equivalently this bottom equation, then which just says that the returns of this, a log return of this NFT from time t to time t prime is have two components: the log changes of the index from time t to time t prime, and then the idiosyncratic part. Okay. So of course, what we are interested in is the first part, the BT prime minus BT part. And of course, we can use regressions to estimate that in this particular form. So that's what we do. We estimate for each time period what is its index B. So another question: are the data before and after the NFT market collapse treated differently, or the data are before the market collapse? There's no reason to treat it differently. So this one, it's depends on which collapse you're talking about, right? In this market, it went up and down a lot. Recently, it did went down a lot, just like any other asset classes you can think about. In our updated sample, we do consider that this one is before 2021. Okay. That trend, that's the way I think about it, right, up or down, is exactly captured by this BT prime and BT. That's what we want to capture. So really, there is no reason to treat it differently. It's just a time dumping you can think about here. Yep. So why do we use this repeat sales regression method? To answer this question, we need to think about what are the potential methods we could use, right? Of course, there are three general methods people have proposed. The first one is just the most naive way, right? We can all think about. Right? The first thing you do is you can think about this one, either using some moments in the cross section to capture that index itself, the mean, the median, the floor price, and so on. Okay. What's the issue with that? Well, the issue is clear because the NFT is being sold at different times, just like a house is, right? Being sold at different time at difference. That has a very important component of selection, right? For example, if just think about the floor price, right? That is the most sensitive to such kind of changes, like little changes, right? If today there is no sold of the cheap NFTs, that floor price will be very high for artificial reasons. Okay. I mean, mean has what we call in like statistics is basically mean is also not robust because like extreme cases would distort the mean completely. Medium is a little bit better, but it's more robust than mean, but still not very good. And then, so of course, this is completely discarded in general in the whole literature to try to construct any index. The second one is essentially the hedonic regression. The hedonic regression is the idea that, well, let's use some characteristics that are common to this particular asset class, and then use that to get rid of that part and see what are the time trends over there. Okay. The issue with in our revised version, we do provide some results on the hedonic. It has some pros in the sense that it gives you some kind of understanding, economic understanding, what are the important drivers of the prices in general. But the problem with hedonic regressions is that you don't know what are the characteristics you want to put in. Even for housing market, that's true. For our market, that's true. But at least for the housing market, like for example, you know certain characteristics you should put in for sure, right? For example, like the square footage of your house, you know that's important. The bigger ones on average, considering everything else the same, would be more expensive than the smaller square footage ones. Or like your zip code location is going to be very important. However, for the NFT market, even such common kind of components might be hard to come up with. Is it like the bigger kind of NFTs as this is supposed to be sold at a higher price, and the smaller in terms of like, you know, how many like pixels in it? I mean, that's not clear, right? Especially when you compare across this kind of sometimes the NFT could be on a digital lens versus some NFTs is on like a piece of art, or some NFTs on the music. How do you compare different characteristics? That's even harder. The repeat sales, you can think about it, it really is takes these issues seriously, thinking about the same piece of assets. Okay, here is NFT. They're being sold twice. Then of course, all the characteristics are going to be exactly the same. That's particularly true for the NFT market. For housing, it could be a little bit different because you can make some modifications to the houses. NFTs, generally, that's difficult. Then you can compare that, the same thing, at different point in time, what are the price being sold for that thing? Okay. Of course, with some drawbacks, what's the repeat sale regression drawbacks is that typically you're going to drop a large part of your data set, because many of these assets are only going to be sold once or never sold before. But if it's never sold, then it's not in any of these data sets, doesn't matter. But if it's only sold once, then you don't see that in your repeat sales. But this happens to be a less of a problem because of just how many NFTs there are in this market. And even using repeat sales methods, you have a lot of observations over there to give you a precise estimate. So let's see how much. So that's the first question we're going to ask is, how much does that time trend, okay, explain the variations of all the repeat sales and all the NFT repeat sales, right? How many of them in our sample is about 1.3 million. Okay? So a lot of NFTs being sold in this about 500 weeks. Okay? So essentially, it's similar to asking a question of, let's just put the time fixed effect, but in a sophisticated way. How much of that time fixed effect explains all the variations in the panel? Which I find is quite remarkable. You get a 29% over there. So this kind of market has a very strong time component over there, as we're saying. Let's look within each individual here popular. Of course, popularity is defined by me. Kind of NFTs collections like CryptoKitties, CryptoPunks, Bored Ape, Subducks, Decentraland. If we do this exercise within a specific NFT collection, you can see that, of course, the R square is going to increase just because we all know that CryptoPunks is going to be more expensive than your random NFT markets and NFTs. What happens is that you get a much higher R square, and that have variations across different entity collections. For the CryptoKitties, that's 55%. When it goes to Bored Ape and Subduck, that goes to almost 90%. What does that mean? That means that if you really like to have a Bored Ape, you really don't need to worry about which specific Bored Ape you buy if you only care about the return. Okay? Because any Bored Ape you buy, you're buying the trend. So 90% of that is the trend. Similar to Subduck. Well, CryptoKitty, maybe you need to do some selections. Okay, some of them the returns can be higher than the other ones. The time trend only explains about 55% of that. So this is the NFT Market Index in general. So there's another question. There are so many more cryptokitties, so that makes yes, there that is also true, and it's also like it goes further back in time too. Right? So like if we look at this index at the beginning, until 2019, it's just all cryptokitties. It's nothing else essentially. Yep. So there are also more cryptokitties over here. But you get one thing that's interesting. Let's think about like it's like Bored Ape has more in terms of numbers than CryptoPunks, but Bored Ape also have a higher R square, right? So it's not. I do agree that the how many of that, like basically how many characteristics the specific collection has, which relates to how many observations and items the collection has, that's going to be affecting the R square, right? Because time trend only can explain that much, but that's not the only thing, right? Some of these crypto NFTs, they just have a stronger time trend versus the other ones, which I also think is interesting. ARM BAYC traded more than CryptoPunks. Yes, so you see that it is traded more. There are more observations over there. What I'm saying is just that the R squares in basically saying that the time trends explaining the Bored Ape is going to be stronger for the time trend explaining CryptoPunks. So the Bored Apes are more similar to each other, essentially. Let's say CryptoPunks are a little bit more dispersed. At least that's what the investor thinks. Very well.
I think there's another question in the chat.
Okay.
Drew said that it would be great if you could explain how the NFT index is constructed.
How the NFT index is constructed. Okay, so it must be I didn't explain it clearly. Okay, so basically it's here. So essentially you're gonna for each this is for each NFT repeat sale, you're going to have a RIT prime T, right? For example, that's I is the Bored Ape number 25. They are being traded on last week and this week. That's what that gives you an R, right? That one can be decomposed into two components. One is the component relates to the aggregate index, which is the BT prime and BT part. One is the one that is specific to this particular NFT, the UIPT prime one. Okay, so essentially you're going to run a regression of all the repeat sale NFTs in the data set, which in our data set there are more than a little bit more than 1 million or 1.3 million of that on the indicators that indicates the time of the buy, which is the BT, and the sell, which is the BT prime. Then you're gonna, for these indicators, you're gonna get the coefficient estimates on them, which that will be your index. And we're gonna normalize the beginning of the index, which is the 2018 first week, to 1, and then look at how they look like over time. So this is essentially what this look like. So the beginning, that's a normalization, right? It's just what it is. And then afterwards, the B's would be sometimes a negative number, sometimes a positive number, and this is how it looks like. Yes, data from all sources are treated equally. That is correct. Yep. Okay. Very well. So there's another question. Okay, oh no, okay, no problem. So let's look at the some collection indexes and how that relates to the overall index over here. So you can see that this is the overall index, which is a solid black line, and the individual collections here we give you CryptoKitties, CryptoPunks, Bored Ape, and then Decentraland. CryptoKitties is actually traded very much similar to the market. You can see that it tracks it pretty well, right, with some wriggles. CryptoPunk, well, the reason why it's so famous is because it went up so much, right? It went up a lot. If the index, in terms of the level of the index, is 1,000 versus if you go back here, that's about 5. So what that means is the CryptoPunk on average is 200 times higher than a typical, in terms of the how much it went up than typical kind of NFT. Bored Ape is also pretty high. It also went up to like 150 in terms of instead of 5 over there. So it's like a lot higher than that. The Decentraland on the other end is actually a little bit lower than the index in general. Of course, this is up to the end of 2021, right? So it doesn't have the pretty significant drop in the more recent periods. So the summary statistics over here. So in terms of the average returns in our sample from 18 to the end of 2021, average returns about 2.5% with standard deviation of 19.2%. That gives you a Sharpe ratio about 0.94. In terms of the return space from each quarter, you can see that at the beginning, the return in the 2018 and 19, the returns are typically pretty low. But when it gets to the 2020, 2021, they have some very high returns over here. In fact, if you only look at the 2018 to 2019, the largest drop is over there, actually. There was a period, the index is only trading at about 10% of the original point at the beginning. So it's a 90% drop, essentially. But later went up by a lot. Let's look at how do you, there's another question. How do you approach NFTs that fall out of the index evaluation because they are bought once and never sold, for example? Essentially, they're not treated. The repeat sale index, the repeat sale method has to, an NFT needs to be treated at least twice to enter the data set. Right? There are methods to incorporate the single sales, which we are essentially, when we're writing the paper, we're doing some of these approaches. But you can think about any of these approach, we're going to say that the single sales, they're less important than the repeat sales, or just because you can think about as, the information contained in them is going to be lower than the repeat sales, right? But we are working on that. Here, it's just not going to be incorporated. Exposures of the NFT market to different asset classes. Let's look at the first one, which is just going to be looking at the its exposure to different crypto factors. The reason to do that is, I think it's straightforward because, well, many of them is actually denominated in other cryptos like Ethereum or other cryptocurrencies. So it's natural to think about that in this way. So the first one is the crypto market factor, and then we also look at some factors we constructed in our earlier papers: the size factor, momentum factor, the value factor. We can see that it's only exposure to two is the cryptocurrency market factor, which is significant, very significant. However, the alpha before the control is about 2.5, now it's about 1.2. Okay, so it dropped by a half. In terms of the variation, it accounts about 21%. So still a large part of the variation, about like 80%, is still unexplained. What about the traditional asset markets? If we do this exercise, basically regressing on the Fama French factors plus the momentum, you can see that mainly is exposed to the stock market overall, but the alpha is still going to be pretty similar in terms of magnitude than before, 2.5 or 2.1, 2.4. On top of that, the reason why there's this exposure is because since 2000, especially 2019, especially 2020, the cryptocurrency market themselves is a very strong exposure to the stock market in general. Okay? And because of the first finding over here, this translates into some exposures to the stock market. What happens is if we use both the cryptocurrency market factor and also the stock market factor control for both of them. The significance on the stock market factor is going to be completely gone. To some other commodities, something to the general commodity index, but it's in terms of the R square is very low. In terms of the alpha it doesn't change at all. This one is we're looking at how does the NFT market relates to some particular cryptocurrencies that has a NFT feature. Think about them as there's like the famous one is this like a mana thing, which is essentially the cryptocurrency you're going to use to trade on. If I understand correctly, the cryptocurrency you need to trade to get a specific piece of NFTs. And there are a bunch of these kind of NFT coins that we call. What we do is we see whether these NFT coins provide additional explanatory power from the NFT market returns in general. You can see that if you request this NFT coin access returns on the NFT access returns or the controlling for the cryptocurrency market, that's going to be significant, suggesting that there's some additional relationship between the NFT market returns and NFT coins above and beyond just the cryptocurrency market returns. What we also find is that the cryptocurrency market takes into the NFT relates to the, how do I put it? The cryptocurrency market is relatively slow in incorporating information about the NFT markets into the NFT coins. Okay, so what we do is we use the NFT market returns to predict changes, to predict future returns of the NFT coins, and you see that there's both a contemporaneous relationship and a predictive relationship over there too. In fact, the predictive relationship tends to be even higher than the contemporaneous ones. So essentially, this is cumulative. So about 2 periods ahead, that's like 0.33 versus contemporaneous only 0.146. So about twice of the information, if you just look at the returns, is only incorporated with a lag. Okay. So question, okay. The question is, I'm interested in the income generated from NFT stakes. For example, Bored Ape can be staked for ApeCoin. Yeah, that would be interesting, but we haven't done that yet. There's also like the interesting thing about like the what do you call that? Like, you know, you kind of distribute some loyalties to the artist, which we actually just got that information. So we're also interested in taking a look at that. Basically, you can think about it as a royalties, exactly. It's a tax on the NFTs, right? You can think about it that way. So we think that's also interesting. So these are all interesting questions. It's just we haven't got into it yet. Yeah. In terms of time series return predictability, so let's look at that one. There are different kind of candidates we think about, basically motivated by the research in the other markets, in the equities and the cryptocurrency markets in general. 5 things we look at: the volatility and valuation ratio. These ones are just a preview. They're going to be important. Attention, zero dependence on volume. They're going to be less important. In terms of volatility, what we find is that during times of high volatility, just in the aggregate market, in the trailing 12-week past volatility, use that to predict future NFT returns cumulatively. You're going to find that it's actually have a negative return predictability. Essentially, at times when the NFT market is very volatile, going forward, it's the NFT market in general is going to have a lower returns. In this result, you can think about in 2 ways. The first way is to think about in terms of finance theory. The second way you can think about it is in terms of the empirical evidence in other markets. In terms of finance theory, this is very surprising. Essentially, that says that if you think about volatility as a measure, as our most primitive measure of the risk of this market, this asset class, that says that high risk, low return. This was a low expected return. But in terms of evidence from the other asset classes, this is actually pretty commonly found. Essentially, in the equity market, we know a very similar result: high inducing credit volatility, low expected returns in general. Okay? So this is also what we find in the NFT market in general. The second one is about this valuation ratio. What's the valuation ratio? Think about in the equity market, that's just going to be some market price, which is the price, divided by some fundamental measure, which in equity market you can think about as the earnings or dividends. Here, the price, we have that for the NFT market, which is just the index. There's some ambiguity of what is going to be the fundamental value. So here we just use the transaction count to do that. Think about it as some like network effect. There's another question. It might be interesting to compare volatility before and after COVID, which might add more volatility. Yes, that would be interesting. For sure. I mean, I think the COVID time, probably there's more volatility, but I need to check on that. But in terms of predictability, it will be harder to see, right? Because think about here, we are doing everything in the aggregate. There's about like 500 weeks, if I remember correctly. Maybe less than that, but definitely not 552 times 5 years. So it's about 250 weeks, okay? Over this period, it's almost like a reach. We're actually surprised if we have any results, right? Because in terms of return variability part, you need some long data series here, just because the volatility of the market is higher, so it basically speeds up time. So we get some results over here. If we cut it even shorter, it would be even harder to do that, essentially. Okay, there's another question. How does this square with what you said earlier about how the lower value NFT produce higher returns? Surely higher price NFTs would be less volatile, and based on what you said, produce higher returns. So this is a time series effect. It's not a price sectional effect. That's the first thing. Okay, and higher price NFTs would be less volatile. I mean, the volatility in individual NFTs is a very hard thing to determine, right? Because think about most of the NFTs, they're only sold once, right? Majority of them. Even they're sold twice, you have a return. Essentially, what the volatility on the individual NFT level, you need at least 3 sales, which is very rich, right? Like information in terms of individual NFTs already to have some measures of the volatility of the NFTs being sold. So that's difficult to know, actually. But in the aggregate, in the market, sometimes it's more volatile than the other times, and you do see that. Okay. Or put it differently. Maybe I should put it differently also to make it a little bit clearer even, which is for the following. Maybe even if there's a relationship between the size and the volatility, that relationship is not going to be too strong. Okay, the size explains volatility with R squared of like at most 5%. So 95% of that's difference. So the relationship could be anything, honestly. The other question is, I wonder how much the wealth influence volatility. That I also didn't look at. We do have the buyer and seller information, so we do know. So one thing, I didn't put it here. So essentially is that this market is very concentrated. Okay, the top 1% of the people in this market controls about, if I remember the number correctly, 30 to 40% of all the trades. Okay, so 1% of people does a lot of the trades already. The top 10% explains, like, I'm not explaining top 10% of all the people, they do about like 70 to 80% of the trades already. So they will be very important in anything essentially. For volatility, I'll believe that's true, but we haven't done any particular tests to show that yet. Yeah. So this one is the valuation ratio. So what we find is that, well, this is again very similar to the equity markets or cryptocurrency markets. When the market price is high relative to the some fundamental measures, here's the transaction counts. Going forward, the return is going to be lower. So basically, it's a mean reverting process. Okay? The price is high compared to the fundamental, it goes down. Okay? When the price is low compared to fundamental, on average, it comes up in prices. Mainly what is moving is the prices instead of the fundamental. That's what it's saying. And that's, for example, the pure kind of sentiment or kind of behavioral things, they don't tend to work as well. For example, Google searches as a measure of sentiments, or some momentum effects in the aggregates. There's not very strong evidence over there either. Volume there are some results there, but if you control for the kind of the valuation ratio and the volatility, it's largely gone, right? There's just not much left after that. So the last part I want to talk about is the cross-sectional return predictabilities. So think about this as before we are really thinking about the S&P 500. What moves, like what predicts S&P 500? Here we're talking about the Apple versus the Microsoft of the NFTs. That's how you should think about it. So what are the characteristics about a specific NFT that is going to be predicting the average returns of that NFT going forward? Okay. What we look at is two main things. One is the size of this NFT, and the second one is the zero dependence, whether there's momentum reversal effect. How do we measure the size of the NFT? Because each individual NFT is different from the other ones. For the size, we use the market cap, which is going to be the price of this NFT. How do we estimate the importance of size in terms of driving the expected return? Well, for individual NFT, we just need to modify the regression we had before on the repeat sales, right? So this is controlling for the this is controlling for the index, the BT prime minus BT, and then you put in the price of that NFT in the first sale, and then look at going forward what is going to be the return from here to the next sale. Okay. What you'll find is that the coefficient estimates on the size effect is all going to be negative, both in the full sample and in each individual NFT collections. This effect is quite sizable. If we double the locked NFT purchase price or the size of this NFT, which happens a lot, right? Think about your Bored Ape versus some random NFTs that is not more than doubled. Okay, this is going to be associated with the 0.4% decrease in the weekly returns, or in other words, 20.8% annualized returns. So it's very sizable. In terms of this, you can also think, so also give your kind of benchmark over here. In the equity market, we know there's a size effect. Larger firms on average, they underperform smaller firms. In the art market, there's also a pretty famous effect. They call it the masterpiece effect, which also says that on average, your expensive kind of art piece is going to have a lower return than the cheap art piece, which essentially is the same effect in the NFT market over here. Another thing we do look at is the zero dependence in the cross section, not in time series. Time series, we just show you that there's not much evidence of such an effect, but in the cross section, we do find such an effect. Of course, to understand the zero dependence, we would need an NFT to be sold at least 3 times, right? First time, second time, and third time. The first and second time, that gives you the past return. the second and third time gives you the future return. We're going to see if there's any relationship over there, controlling for essentially the market trend. Okay. So putting in the past returns of the NFT repeat sales, looking at the future NFT, the same NFT repeat sales. What we find is that there is a very significant negative return over there, essentially saying that if your NFT appreciate a lot before, on average, this particular NFT return is going to be lower into the future. So it's a mean reversion in the return space. This is true for the full sample, and again, similar for any of these individual collections that are popular in the space. This effect is also more pretty sizable, not as big as the size effect, but pretty sizable. A 10% increase in the average weekly returns of the NFT's previous repeat sales is in general on average associated with the 7.3% decline in the annual returns. So let me just briefly conclude. If we have any other questions, I'm more than happy to answer that. So in this paper, what we do is we construct an index for the overall NFT markets. We also have a website that shows that. We give you some summary statistics for this markets, how it look like. It's very volatile. It has a lot of strengths essentially in this market. In the cross-sectionally, there is a size effect and a zero correlation effect, reversal effect. In the time series, mainly the volatility and also the valuation ratio, they give you some probabilities in the overall NFT markets. And it does have a lot of connections to how things evolve in the equity market and cryptocurrency market, right? We do see a lot of these similar investor behaviors, essentially, which leads to a similar return patterns in the NFT markets. Thank you very much.
Thank you very much, Yukun, for the wonderful presentation. So any questions from the audience? You can turn on your microphone if you feel that helps you communicate with Yukun better. Okay, so as people start to compose their questions, I actually have a few questions.
For sure.
Notes. So one is that maybe I haven't really understood the econometrics here. I'm wondering as so we are in a market downturn right now, right? Mm-hmm. So if this market downturn continues in the next few years, if that's the case, then and if let's say 5 years from now you do this research again, including the data from 2022 to 2025, would the results be different in terms of like the return rate?
Yeah, of course it will be different. It's like same as, but it's like out of sample. You never know what's going to happen, right? It's like that's the same as saying, well, so S&P 500, we know there's a lot of returns in the past. Is it going to be in the next 3 years? Is it going to be the return the same as the previous one? That's the $1 million question, right? If I know that question, that would be great. Yes, yeah. But that is what everyone is trying to figure out, right? Yeah.
So what was the time period of the data that you included in this study?
So this time period is from 2018, the beginning of 2018 to the end of 2021. We actually we extended to the 2022, basically to today already. It did went down a lot, right? So the index at that point in the end of 2021 is about at the level of 5, right? Compared to the beginning of 2018 is 1. Right now it's like a 1 point something, less than 2.
Okay.
So how much drop is that? 5 to 2, right? It's like a 60% drop. But is that surprising? Like the stock S&P 500 went down by 40%, right? So it's like
that's true.
Yeah. Nasdaq went down by 40%.
Yeah. So then my other question is that a lot of our registrants for this event are probably not from economics or don't have a strong background in mathematics or finance. So if you are going to give them some takeaway notes, what will be the takeaway message for those who probably don't understand the math here very well?
Okay. So I think let me, from a broader picture takeaway, let me give that one. Okay, so essentially it's saying to understand if we treat any market as an asset market, which that's essentially the way we're treating the NFT market, the first thing you want to know is how does the market in general performs. Okay, for some of these markets, it's very easy to do that, like the equity or the cryptocurrency market, right? You really don't need a PhD to do that, right? You just, for Bitcoin, you see each second there's a trade on Bitcoin, you know that price, like because you have a trade. But for some other markets, like the NFT market, you don't know, right? You don't know, like what does a representative NFT even mean, right? It's not a meaningful concept. Instead of Bitcoin, each Bitcoin is representative, right? So people come up with many ways, some clever, many very dumb ways to measure their aggregates. You need to pick the correct way to measure it. And that is what we're trying to do. So essentially give you what that aggregate market look like over time. And then on top of that, and which is going to be very important, right? So that leads to a bunch of different things, right? Like you can think about how that market evolves, and then you can think about how does individual NFTs outperform or underperform compared to the market, right? Otherwise, like in good times, every crypto NFT is going up, right? But what does a good performer even mean, right? In different markets, the benchmark is very important. Yeah, and that's what we try to offer.
Okay. So I guess there are some community members today in this talk, and I guess that some of the community members, who haven't had much knowledge about NFT or cryptocurrency, when they listen to your talk and when they see the double digits average return, they will think, wow, NFT is a fantastic investment object.
But like recently, it's been very bad. Yeah, so be careful.
Yeah, yes. So if you're going to explain the risks to them, if you're going to send them a cautionary note, right, using some of the financial terms, then what would you say to them?
So the volatility is very high, right? That's the first thing you want to pay notice to. Not just the reason, right? Recently, it's very high. It went from, I just referenced that, right, 5 to less than 2 already. So like a 60% drop, right, which is higher than the stock market, right? Stock market, like Nasdaq went down by like 35% probably, like less than 40%. So that's a more significant drop than Nasdaq. On top of that, there's a much less noticed one earlier in the life cycle NFT drop too, which is basically you can think about the drop in the CryptoKitty prices. If you still remember, in 2018, there was like a huge CryptoKitty kind of, no one called it NFT at the time, but it is NFT, right? That price went up a lot, but by the end, in our data, essentially, if you look at the index, by the end of 2020, that index is only 10% of the original, right? So it's not like super noticeable because like it went up by so much, but like if you zoom in there, it went down by like 90%. But this market is very volatile. Afterwards, it went up by a lot, so like from 10%, 0.1 all the way to a 10, which is 100 times increase. So you can think about it, it's in a way, it's like the cryptocurrency itself, right? When you invest in cryptocurrencies, you need to bear in mind about the volatility that associated with it, right? In a good time, it went up by a lot, but in bad times, it also come down by a lot. I think that the more reasonable investor, I would think, is you have some fraction that are invested in these assets, which give you some very important diversification benefits and exposures to it, but not everything in it, right? Otherwise, you know,
So
it's like a roller coaster.
Yeah, so I guess it's like, you know, even though the average return seems pretty high, but it doesn't mean that as an individual investor, you're going to pick the NFT that is going to increase in value.
Yes, that is also a great point, right? Like Bitcoin, every Bitcoin you pick, they're exactly the same. NFTs is like, well, this is telling the market how it look like. To get to the market, like the what statistics says that you need at least 30 to 40 different assets. So basically, you need 30 to 40 uncorrelated and largely very idiosyncratic NFTs to reach that market. Your individual NFTs could outperform or like underperform that market. So that's additional risk about the non-diversibility of this particular asset class.
Yeah, I think that's a very, very useful point. Okay, so I see that we are on top of the hour, and thank you again for the wonderful presentation, and I'm sure that everyone here learned a lot today. And we have recorded this session, so we're going to post the recording to our website. And if anyone of you wants to watch it again or want to share it with your friends or colleagues, please do so. All right, so on that note, have a great day, everyone, and thank you for joining us.
Thank you. Okay, bye-bye.
Thank you, bye-bye.
Thank you.